Well, hello, traders and investors. My name is Roger Scott. Today is the 30th of December. It's a Wednesday. We've got New Year's Eve tomorrow. Tomorrow is going to be the last day of the year. But I've got a lot to talk about. We're ending the year on a high note, but you've got to be very, very cautious. So let me tell you what's going on right now. The big news today is the international trade in goods. The number was expected to be about negative 82 billion. It's actually down further. It's about $84.8 billion. The U.S. good deficit, as you can see here, is expected to widen to 82 billion. That's the number versus 80 billion in October. So it's getting wider, not narrowing. Goods imported rose solidly in October and were up 5.1% from the pre-pandemic. But goods exported rose solidly, but were down 8.4%. So we're not seeing a big issue with imports. We're seeing a big issue with exports. And that's on our side. So that's a big issue. And that's something that's going to reflect in the GDP estimates because retail sales, import, export, that's what we're importing, things to sell, back and forth, exporting and importing. That's going to reflect negatively on the GDP. So this is an important number to watch. As far as further reports this week, we've got jobless claims tomorrow. That's the other big report, and pending home sales, but that's not here nor there. The jobless claims report is going to cement this year, and it's going to tell us if we're starting to see even higher numbers or the numbers come down. We've been fluctuating between 700,000 and 900,000 weekly jobless claims between, say, May and right now. And the number went down, dipped its toe into 600,000, and then started moving back up. And now we're looking at a consensus of 830,000, and I'm hoping the number will be lower than this, because if it's higher than this, if it's above the moving average, the 4-week moving average, it's bad. And the consensus is already above the 4-week moving average, so it's not that great. But this is telling us that the economy is not getting out of this COVID mess as fast as we expected. So that's the news that we've got to accept. And keep in mind, 95% of hedge funds and institutional traders are out of the market right now. So I don't think these reports will have such a big impact till next year's trading action. And no, we're not getting a Christmas rally or any type of rally because retail sales sucked, and the rallies are caused by the retail sector. So we've been kind of hovering because of this stimulus bill that passed. We've been moving higher, but not because of a typical Christmas rally when retail begins outperforming because retail sales are so strong. We have not seen that this year. And again, we could potentially see a rally tomorrow. The market's not going to be working full on. Most people are out, as you can imagine, but the jobless claims is tomorrow, and we're looking for a number below the 4-week moving average, below the 818, 820 level. Anything below 800,000 will be very, very positive. Now, if you look at the numbers, the market is up a little bit. The $2,000 check that Trump was hoping to get out to individuals was cut down by Senate and Congress by I don't know why, but it was. I wish it wasn't, but the market looks like it's cooling off. And again, I'm hesitant to be very bullish right now because usually when markets are opening higher and they sag intraday, it's not a positive sign. And let me give you an example of what I'm talking about. This is the NASDAQ 100. Let me give you an example of what I mean. If you look at the trading action yesterday, you will see that we jumped up, peaked out, and kind of closed near the bottom. So if we don't go higher today, it's not a very, very positive sign. Looking at global market news, world shares edged higher on Wednesday as some markets actually wrapped up trading for 2020. Tokyo's benchmark fell after surging to a 30-year high. That's not a bear market, folks. Gains were modest after a lackluster day in Wall Street as the boost from President Trump's signing of a $900 billion coronavirus relief package faded. That's because the package is not as sexy as it appears to be. And now with the Senate blocking the $2,000 cash, that's not great either. On Wednesday, Britain authorized use of a second vaccine, becoming first country to greenlight an easy-to-handle shot that its developers hope will become the vaccine of the world. Well, let's hope that's the case. Within 2 days of trading left in 2020, the S&P 500 is up over 15% this year, and the NASDAQ is up 43%. That's crazy. And this is why I think next year things will be a little different, especially the first quarter, first half of the year. I think we're going to see some choppiness and a good ending of the year, but we may see some, choppy roads ahead. An effort by Trump to get bigger $2,000 COVID relief check for individuals stalled in the Republican-led Senate. They've been blocking him on every turn to give more money actually lately, which is not really that great, but I'm not going to get political. For now, $600 checks are set to be delivered along with other aid in one of the largest rescue packages of its kind. The market sure doesn't feel that way. Investors have been waiting months for such help, which economists say is needed to tide the economy over as COVID caseload surges, leading governments to reimpose restrictions. And again, I believe, in my opinion, we're going to see the next 3 months relive what we've been seeing in the early 2020 because the broad market doesn't have the vaccines just yet, and most people are not getting it for another several months. Now, I want to show you these are the 10 individual sectors of the economy, and I want to show you something. So look at financials. It's looking really strong, right? It's looking just about as strong as consumer discretionary and about as strong as the industrial sector. But I want to show you something interesting. Look at the long-term chart. Never took out that February high. I'm not trading any sector that hasn't taken out the February high, unless the individual stock took out the February high. And there's not that many of them. So whenever you're looking at a sector or a stock, make sure you look back far enough to see if it took out the February or March high. If it did not take out that March, I think it's, what is it? It's the end of March. Basically, the period before the market dropped in end of February, early March, if it has not taken out that price action, it's too early to jump in. Now, if you look at consumer discretionary, it took it out a long time ago. If you look at basic materials, it took it out a long time ago. But financials has not, and it's been really performing strong for the last few weeks. But I want you guys to be very cautious because it has not taken out that high. And that hurdle is very important. If an asset or an ETF has not taken out the February 2020 highs, that means it has not recovered yet, or has not, in terms of the investor sentiment, has not recovered from the downside of COVID, and means we have no business going into it. Now, I've been very bullish the industrial sector, and I've been very bullish the basic materials sector. But both of those sectors, even though they've taken out the high, I don't like the fact that they've stalled out here, and they look kind of neutral at this point. And same thing with industrial. They were leading, and now they're moving sideways. So I would be very, very cautious that we don't see a downside on basic materials and industrial. What I'd like for you guys to do is actually wait for the basic material sector to trade above 72, 50, 73 before you look back into it. Now, I like this congestion, but remember, congestions lead to vertical moves, and we don't know if it's going to be a vertical move up or down. So till we see this sector, XLB, show itself or prove itself, I would be very, very cautious. Same thing with industrial. Notice the congestion. Well, it took out that February high. But again, I don't like this congestion. I like what I'm seeing, though, on the consumer select sector, consumer discretionary sector. And I like, what I'm seeing on technology, because they're moving directionally. Now, here's the problem with that theory. Remember what two sectors rallied hard when the market dropped beginning of this year? Consumer discretionary and technology, because those are the stay-at-home sectors. So what we may be seeing is another spike from the stay-at-home sectors if beginning of the year we have a huge spike in COVID cases like we're seeing right now. According to CNBC, we're in a horrific period, and there's no vaccines to help us out, and the economy turns again. If that happens, and I've been predicting that, folks, because put-to-call ratios are crazy, we may see a spike in the stay-at-home stocks, and that would give technology and that would give consumer discretionary right here, these two sectors, more upside. Notice they've been moving higher, took out the high. Same thing with technology, especially chip stocks, moving higher, taking out the high. But I don't like this basic material, and I don't like this industrial trading action. Now, these sideways congestions sometimes can lead to bullish moves too. So don't rule out industrial and basic material, but I want to see industrial take out 90.26 to the upside before I'm long again. And I want basic material, to take out 72.64 before we're long again. But meanwhile, keep your eye on technology and consumer discretionary. Those two sectors are still moving directionally. And if we experience similarities to what we experienced last February, March, April, and May, then technology and consumer discretionary, because those have the most chip, cloud, stay-at-home stocks, those could have the potential to spike again. So I'm not completely bearish on basic material and industrial stocks yet. I've been very bullish on them the last quarter. I'm very neutral on them right now, but I'm getting bullish again on tech and consumer discretionary because I believe first quarter of 2021, we may see a COVID-19 pandemic spike again. And that would mean these stocks would go up. So again, I'm kind of shifting focus away from basic materials and industrial till the sectors can prove themselves. And I'm again going bullish on chips and consumer discretionary because I'm seeing a little spike in retail. I'm seeing spikes again in the stay-at-home stocks. I'm seeing stay-at-home stocks closing the year on a strong note. And that's leading me to believe that there's a good chance we may see a repeat of what we saw February, March, and April, which means lowering exposure, having a panic sell-off, and a spike up in technology and consumer discretionary. So again, keep your eye on material and industrial versus technology and consumer discretionary and see which ones out of those two, because they kind of work together. Basic materials and industrial work together, and technology and consumer discretionary work together. So keep an eye on these four sectors. They're going to give us a great indication of where the money's moving into the first part of 2021. If you see basic material and industrial pick up again, there's a good chance we won't see a major correction like we saw in February. But if you don't, and if you see a sharp spike in COVID and no more money from the Fed, we may see a very similar situation to what we saw last 2020 and the February, March, and April. I think the good gauge will be put to call ratio and looking at the technology and consumer discretionary and comparing it to basic material and industrial. And I think I gave you more than enough today to keep you guys busy. Now, I've got something important for you. Especially, this is very important, especially in light of what I'm talking about right now. Did you know there's a hidden market that explodes the first year a new president takes office, regardless of their party affiliation? In fact, this one market gave investors the opportunity to earn 153% on their money the last two times Democrats were sworn into the White House. And I think this could happen again in 2021. It happened two times before. And the market is really setting up for it right now. But there's only one catch. There's always a catch, right? The window to take advantage of this hidden market is rapidly closing. And you need to learn about it before January 21st. There's a date involved here. That's why I decided to host my annual Turning Point event before Joe Biden takes office, giving you the best chance to grow your account in the new year. Folks, there's only one thing left to do. Take advantage of this opportunity. Discover this market. I'll give it away. All you got to do is sign up, watch this timely event, and get in on it. And get your chance at earning 153% before January 21st or around January 21st of next year. I want to set you guys on the right track. I think I've got this market thing figured out pretty well. At least I think I do. Anyway, guys, follow the link. Check out. This is a timely announcement. You don't want to miss my Turning Point. It's how I start the year every year, and it's been treating me right every year. And post some feedback. Like these videos. I want to hear comments from you. How else am I going to get better at doing this? Or, if you like it, let me know. If you don't like my shirt, if you don't like the way I talk, if you like stuff I do, let me know. Wish me Happy New Year's, because I'm wishing you the best New Year's ever. Bye, guys. Love to hear from you. Take care and have a blessed New Year's.